What's up, everyone? I hope everyone's good. I hope everyone's having a good trading week, and I hope everyone's killing the markets in general. So this is going to be the first official video uploaded to the JM Markets YouTube channel. So in this video, we'll be covering how to basically get the best entries using supply and demand. But just before I actually go into understanding how to basically get these best entries, I'm just going to announce that I've actually just released my course, basically a full course on understanding how I trade, basically understanding how I get these entries that I do, which will teach you how to basically get similar entries and basically elevate your trading overall. So if that'll be something that you're interested in, just head over to the link in my Instagram bio. I'll attach a video here just to show you how to basically locate it, and you can basically understand how I trade and basically elevate your trading overall. But nonetheless, let's hop into this video and basically understand how to get the best entries. So there's going to be 4 things I'm covering in this video, and those are going to be how to basically correctly locate a valid area of supply and demand, understanding what makes an area of supply and demand more valid than other areas of supply and demand, and understanding premium and discount prices, and also another confluence I'll be covering at the end that basically you can identify when looking at a potential setup, which basically increases the probability of this trade going in your direction or in your favor. So we're going to get started off with how to correctly locate valid areas of supply and demand. So when looking for areas of supply and demand, we refer to the market schematic of either reversal zones or continuation zones. Like the price cycle and everything, contraction, expansion, retracement and reversal. However, once we've identified these zones, we do not mark out the entire area of contraction. We simply mark out either the last area of supply or demand before. So what I mean by that is basically the last bullish candle before we have a sell-off, or the last bearish candle before we have a rally to the upside. And also, when we mark out these areas of supply and demand, we don't mark out the whole contraction phase. We just simply mark out from the candle to the candle, from the wick to the wick of the last area of supply or demand. So as you can see over here, we've got this area of supply that we marked out. We can see there's a contraction phase that I've highlighted here with this rectangle, and then we see the expansion to the downside. However, we don't mark out the entire area of contraction. We just mark out the last bullish candle before we have the sell-off. As you can see, it was this area of supply. Personally, I like to use the rectangle tool when marking out these areas of supply. You can use horizontal rays. You can either edit the Fibonacci tool to basically, mark out these areas of supply and demand. Personally, I use the magnet tool when marking out these areas of supply and demand. Reason being is that it increases the accuracy of the markup. It basically makes sure that I'm getting it from the wick to the wick, just to basically make sure that my stop loss is not too big, or I miss the open of the candle and basically miss the trade as a general. Also, like I previously mentioned, we don't mark out the entire contraction phase. We wouldn't mark out the zone from here to here. We just simply mark out the last area of supply or demand. If we move on, we can now see that this is the complete price cycle here. So you have the contraction phase, then we have the expansion to the downside, then we've got the retracement where price pulls back into this area of supply, and then we see price mitigates this area of supply, and then we see a sell-off to the downside. See, we wouldn't mark out this area here from here to here. We just mark out the last area of supply. As you can see, also when targeting areas for potential take profits, you can look at areas like here. We've got this area here where we can basically call it a bit of consolidation. There's not really any market dominance here. Price is basically ranging, going side to side, and there'll be probably an abundance of liquidity laying below here. So we could target areas like that, or we could target this area of demand. As we can see, price pushed below this area of contraction, well, basically ranging here. Price broke below it. We can also see that price did actually reach this area of demand. So we could either set our take profit areas like I've just previously mentioned. If we move on, so what do we do when we're faced with multiple areas of supply or demand? So how do we identify which area is more valid than the other areas? And what we use is a tool called the Fibonacci retracement. So that's how we identify premium and discounted areas of supply or demand. We look for basically areas of supply or demand that are further away from market equilibrium. I'm going to be covering what market equilibrium is in a second. So like I said, premium and discounted areas of supply or demand within the market is the answer to the question of how we identify which zone is more valid. So when also we have to understand what market equilibrium is. So what that is basically is it's the 50% mark on the Fibonacci tool. It's basically, you know, fair, not really a fair price. It's basically where the sellers and buyers, there's no real market dominance. It's you know, fair pricing. Actually, it's like it's not the best price to get in. There's no premium or discounted pricing there. It's just a fair price. It's basically market equilibrium. It's the middle zone basically. So when we look for long positions in the market, we want to be entering at the cheapest price possible. And so what I mean by that is we want to be getting at the most discounted area. So the further away from the market equilibrium, below the market equilibrium, is considered more discounted, and we want to be getting at the cheapest price possible so that we can also maximize our gains. But it's also a confluence, and it basically increases the likelihood of this trade going in our favor, basically getting in at a more discounted price. And the same applies for when we're looking to short positions. We want to be entering at the most premium level. So pricing areas of the Fibonacci above the market equilibrium. So I'll be covering what those, you know, actual percentages are within the Fibonacci that we'd be looking out for when marking up areas of supply or demand and understanding whether they're premium zones or not. So in order to identify this, like I said, we use the Fibonacci tool. So if we move on, we can see that the key zone, the key levels that we use when identifying whether a zone is premium or not, or discounted, is we use the 62%, 70.5 and 79% areas within the Fibonacci. So those will be either, if you're looking for a short position, those will be above the market equilibrium, and if you're looking for a long position, those will be below the market equilibrium. So when we're looking for a short position, the Fibonacci tool is drawn from the swing high down to the swing low, and when we're looking for a long position, it's drawn from the swing low up to the swing high. So as you can see in this chart I've basically placed below here, you can see that there's multiple areas of supply, and you'll be faced with which one do I enter from? And this is where the Fibonacci tool comes into play. As you can see, I've marked it from the swing high all the way to the swing low, and as we can see, this purple line highlights the market equilibrium. And as you can see, we've got the 62%, we've got the 70.5 and the 79% zones here. And as you can see, this area here would be considered the most premium area of supply, as it is within the most premium zone of the Fibonacci, and it is further away from the equilibrium. So this would be the best price when we're looking to enter a trade. So this is where we'd be looking out for. That's the most probable area of supply to work in our favor, and the same applies for a demand zone. We'd mark it from swing low up to the swing high, and anything that is within these premium levels, we would be looking for to enter our trades from these zones. So moving on from the Fibonacci, I'll be going over some live chart examples just in a second. I just want to cover the extra confluence that we look out for just before I jump into the live charts. So on top of being able to identify the most premium zone, there are a few confluences we must look out for when identifying a valid area of supply or demand. One of these confluences I'll be covering in this video. The rest will be covered in the course. Everything will be, the complete guide will be in the course. So if you're interested in learning about all the confluences I look out for when entering a trade, just head over to the link into my bio and you can find it all there. So one of these confluences that I'll also be covering will be identifying a shift in market sentiment. So what I mean by that is identifying whether there's going to be basically a shift in the market trend, and this can be done by identifying after the supply or demand zone has formed whether it was followed by a change in character. So as you can see in this little chart that I've actually put down in the slides here, you can see that price was creating higher highs and higher lows, and then we see price pushed down to the downside and is followed by a change in character. So this gives us a confluence and confirmation there's going to be a shift in the market sentiment. It's an extra confluence that we look out for, basically increasing the probability of this trade happening in our favor. And as we can see, price then pulled back into this area of supply, and we see a continuation to the downside. So I'm going to be jumping into the live charts now, and I'm going to be running through some live chart examples, and I'll be breaking down a 300 pip movement that I caught on AUD JPY, and basically explaining how I caught it, what I looked out for, and basically everything that I looked out for when entering that trade. So as you can see, we've got Euro AUD here, and we have, I believe it to be on the 2-hour time frame, we've got this area of supply that I located here. And when it comes to interpreting the Fibonacci, if I mark it from the swing high here down to the swing low, as we can see, from the wick to the wick, we can see that this area of supply that I marked out was located within one of these premium zones. As you can see, between the 70.5 and the 79%. So this would be considered a premium area of supply, increasing the probability that this is going to work in our favor. And what do we also see? We see here that price was creating higher highs and higher lows. So higher high, higher low. Higher high, higher high, higher low, higher high, higher low, higher high. And then we see a push to the downside, and price breaks below this low that was formed previously. And this is basically a confirmation that there's going to be a shift in the market sentiment for us. So we look out for these as well, because it adds the confirmation to us that price is likely to go in our favor. And what do we see? We see the expansion to the downside. Then we see the reverse retracement back into this area of supply, and we'd be looking to enter our trades from, the open to the close. Our stop loss will be placed just at the close, and our take profits could either be at this low here, this area here, or just below, just for it to clear liquidity. And what do we see? We see price actually does react off of this area, and we see a push to the downside, and we see that price actually does mitigate this area of supply and move to the downside. So if I move on to US dollar CHF, we can see we identified this area of demand on the 1 hour time frame, I believe it to be. And we can also mark our Fibonacci tools from the close and the open of the candle. It doesn't have to be wick to wick. So if we mark it out from the candle here to the swing low to the swing high, from wick to wick, from close to close, we can see that this area of supply, of demand, was actually located within a premium zone as well. So this was a discounted area of demand, and we can see that price then pulled back into this area of demand, and we see that price mitigated this area of demand, and we'd be looking to enter our trades from this area of demand. And what do we see? We see price push into an area of supply, filling imbalances on the way up, and this is an area we could be placing our take profits, an area of supply imbalances, equal highs, equal lows. As you know, these are areas where we place our take profits, areas of liquidity, because the market chases liquidity, it likes to clear liquidity, and that's where we basically set our stop loss, our take profits at. We want to basically chase liquidity alongside the big financial institutions. So moving on, we've got the GBP USD. So on a higher time frame, we identified this area of demand, and if we mark out from the previous low to the high, we can see that this area of demand was the most extreme area of demand. It's the most discounted area of demand. It is within the 79% on the Fibonacci. So it's the most discounted area of demand that we'll be looking at to enter our trades from. And we can also see that price was on a downtrend. It's creating lower lows and lower highs, and then we see a push to the upside. Price breaks above this previous high, lower high, and we see a change in character. So that basically is a confluence. There's going to be there's a shift in market sentiment, and as we can see, price then pulls back into this area of demand, and then we see a nice push to the upside. Like I said, take profits could be either areas of supply or demand, depending on if you're shorting or longing. Imbalances, equal highs, equal lows, retail patterns, areas of liquidity. But we can see this is how we identify areas of valid areas of supply and demand. We use the Fibonacci tool to identify more premium areas of supply and demand, and it basically increases the chance of this trade working in our favor. And if I move on to AUD JPY, this was a 300 pip movement that I caught two 300 pip movements on this pair. So I'm going to be breaking down why I execute these trades. So initially, I identified these two areas of demand, and as you can see, this area of demand would be considered the most extreme area of demand. It's the most discounted area of demand. There's no areas of demand below it. It would be considered, like I said, the most extreme area of demand. We also had this area of demand above this area, but we'd consider this area, like I said, a less discounted area of demand, so it's less likely to work in our favor. And what do we see? If I just change it to the demand rectangle, we can see that price reached this area of demand. This will be early buyers liquidity, and then price eventually broke below this area of demand, and we can see that price reacted off the more discounted area of demand, the most extreme area of demand, and we can see that there was a push all the way to the upside. And where was I setting my take profits? As we can see, there was this massive imbalance that formed when there was this big sell-off. And if we jump onto the 4-hour time frame, we can see that there was this area of supply that formed just before the massive sell-off. And this is where I was setting my take profit. Like I said previously, we can set our take profits at areas of supply, areas of demand, depending on if you're longing or shorting. If I jump back down to the 2-hour time frame, we can also see that there was areas of liquidity that needed to be cleared. So also on top of this area of demand, as we can see, price hit this area 3 times. So this would be considered trendline liquidity as well. And like I said, the market likes to chase liquidity, clears liquidity. That's where the institutions capitalize on. That's where the money is. And as we can see, price broke below this trendline liquidity, cleared the liquidity, and we see price then react off of this area of demand, the most discounted area of demand. And then we see this push to the upside. So if I move on, there was another trade that I caught from this pair as well. I believe it was on the 2-hour time frame as well. So if I just delete this area of demand that I marked out from before, we can see that there was also this area of demand here. And as we can see, we have this area of early buyers liquidity, less discounted area of demand. So we've got this area of demand and this area of demand. So this area of demand would no longer be considered valid because it's been mitigated, so we wouldn't look at entering trades off of that area of demand anymore. But as we can see, we also have this area of trendline liquidity as well. And we see we had this massive impulse to the upside, and then we see a pullback down to this side here, but we also had all this inefficient price action as price was moving to the upside. And we see that this area here would be considered a less discounted area of demand because it is going to be closer to the market equilibrium. So if I just pull out the fib tool from here to this high here, we can see that this area here would be considered the most extreme area of demand. It's in the 79% region on the fib tool. So that would be the area that we'd be looking to enter our trades from. Also, price has to fill in these inefficient price action, which it did. So we'd be looking to enter our trades from this area here, and we could potentially set our take profits at areas of equal highs around these areas here. And we can see this was another 343 pip movement that I actually ended up catching. So that's it for in terms of identifying areas of supply and demand, which one's more valid. Just to recap it, we look for the most premium areas of supply and demand when entering trades. We look for a change in character formed after the formation of the area of supply and demand as an extra confluence, and price basically chases liquidity as well. So we look for areas further away from the market equilibrium and areas that have liquidity around it, because price always follows the areas of liquidity because that's where money is made. But that's going to be everything for this video. I hope you actually learned something from this video. Make sure you also check out my course and my link in my bio. It'll be 24/7 Discord support and basically complete course covering everything that was included in this video, and also everything else in terms of all the other confluences I look out for when identifying potential setups, and basically how to execute trades like myself and basically increase your profitability and success rate. But that's it for today. I hope you enjoyed this video, and I hope everyone has an amazing week.